G'day everyone, welcome back to another trading strategy video. In my daily video updates, I talk about the weekly, daily or the daily trend. If they align, then trade using one of my strategies. This strategy is one you can apply, and I've also got some other strategies which I've posted previously on the YouTube channel. So just go to the strategy playlist and look those up. But this is just another one of those with a more recent update. I'm not going to talk too much about the divergence. If you regularly watch my daily updates, you should be familiar with the divergence and concept rules. So let's get stuck straight into it. First off, I'll go through a few chart examples showing the entry and exit stages and where to average down if price goes against you. So that's the average down. So just give you a quick update here. This is the profitability chart up here, and these little steps indicate how many contracts have been entered. So you can see there one contract entered, and each where there's a gap, that means it's sold off. So we closed the trade there, and these arrows and crosses indicate where you buy and where you close the trade. We're only going long in this example. There's no short examples, but it's basically when I show you the rules, it'll be the reverse for going short. So again, this is number of contracts entered. These are all single contracts. You can see there, entry there and exit. This one averaged down 3 times. So obviously this is the price chart. This is Heiken Ashi, and most trading platforms have got the Heiken Ashi tool if you want to use that. And down here we've got our oscillator, and I'll go through the calculations on how to set this up. Down here, this is based on the oscillator. It just gives you a very easier pictorial in terms of where it's long. You can see there long, and where it starts turning down. Of course, you can put in red different moving averages to show an upswing or a downswing, but I just like using this. It's a bit more direct in terms of showing me upswings or downswings. And then down here we've got our CCI 150, which again is is available on most charting software packages. So here we're going to be trading the 1 hour chart, and over here we're going to be using the weekly trend. So only trade when the weekly trend is moving in an upward direction, and I'll zoom out on these in a minute. So first off, I'll redefine the multiple moving average calculation and go through entry and exit trading rules, and then show you the application. So here we've got the multiple moving average oscillator, and I've covered this in previous videos, but I'll just show it here again for you guys. So again, this is a calculation. We use the multiple moving average oscillator with a period of 5 and using an exponential moving average. So basically looking at the EMA 15 using the close and long EMA 60 on the close. So basically subtract the long from the short and apply moving average, exponential moving average 5 to it. And that gives you this oscillator, which you're familiar with. And obviously you buy or go long when it's in an upswing, and go short or sell when it's in a downswing. So that oscillator is used here in the application on the hourly time frame in this example. And we also, again, as I said, when it's applied here as well when it's in an upswing. And again, that indicator down here just indicates the upswing of the oscillator. So we go long only during this period, and we avoid trading when it's in a downswing on the daily. Now on the daily as well, we've got some trading rules. Let me show you the trading rules first off. So like I said, we're going to be using the hourly time frame here. So we're trading on the hourly in the direction when the weekly is in an upswing. So what we're looking at is when the close is greater than the moving average 200. So we apply moving average 200 on the price chart. So this light blue line here is a simple moving average 200. So we only go long when the price is above this moving average. Okay, I'll zoom out a bit. We don't go long. It shows long there, but that's because that spiked above the moving average. So you've got to be careful of that. I'll talk about why it's using that as well. So we only go long when the close is greater than moving average. we only go long on the daily, on the hourly here, when the multiple moving average, oscillator 5, is increasing. So again, you can see here, for example, the close there on this particular bar is greater than the moving average, and the oscillator here is increasing. So that's the other parameter you must follow. And then we look at the Heiken Ashi bullish on the third bar. So you'll notice we enter there on the third bar. Now why is that? Because we want to avoid, and if you're not familiar with the Heiken Ashi, let me just quickly change that back to a simple bar chart or candlestick chart. We're trying to avoid the noise. So Heiken Ashi is typically used to give us a clearer indication of trend. So that's a normal bar chart, and this is using a Heiken Ashi candles. If you look it up on Google or YouTube, there's other channels that explain it probably better than this, but just trust me for this exercise. Use Heiken Ashi in this example, and I like using 3 bars elapsed before entering the trade. Likewise, we exit the trade after 3 bars on the downside as bearish candles, and that's to avoid little noise. You'll notice here there's a little bearish candle there, another one there, but they haven't given us 3 consecutive down bearish candles. Until that point there, that's given us 3 bearish candles, and it exits the trade. So you want to try and avoid the noise, so it gives us a clear indication that way. Enter when it's 3 candles bullish, and exit when it's 3 candles bearish. So that's what the last exit strategy says. The close position when the Heiken Ashi is bullish on the third bar, and the close is greater than the open average. So obviously, when you don't close the trade, for example, if you entered long on that one there, you don't close it if the current price is less than that point. So in other words, you want to get out with a profit. So let me go through those rules one more time. I'll give you a minute or a few seconds to maybe screenshot that. So basically, trade only in the direction of the weekly or daily, and here we're using the hourly time frame to trade, but we're going to be trading in the trend of the weekly. But the first parameter is when the close is greater than moving average 200. The oscillator is increasing, and a Heiken Ashi is on its third bullish bar. Then we close when the price is greater than the original open price. The close price is greater than the original open price, and the Heiken Ashi is on a bullish third bar. Sorry, bearish third bar. That should be bearish. I'll change that. That should be bearish third bar. So that's where we are with that. So as I said, we're trading the New Zealand US dollar, and this applies almost to any commodity. And I'll show you basically if you're going to be trading on the shares, and I'll cover that in a minute. If you're going to be trading the shares, I suggest trading on the daily and looking at at least the weekly trend to get the overall trend following approach. So the other thing to consider as well is, and again with my daily updates, I do talk about the divergence. So you can see here, for example, there's a nice clear divergence showing on the CCI 150. So just consider that as well. So if you are trading this at the moment and the price is going up, let it run. But just be mindful, if you're trading this on an hourly basis, you may want to close your position somewhere in there. If you're going to be if it's going to be trading your nighttime, just be mindful that the price may collapse at any moment there, which it eventually did, and the CCI continued to the downside. And again, I'm not going to show you how to trade the divergence in this case. This is an indication of where to exit the trade if you're already in a profitable position. Now, one thing to notice as well is I normally use the CCI 150 for a divergence. It's a bit more reliable. But you'll notice here as well that there is a bearish divergence. Let me just maximize that. So you can see there's a bearish divergence. And it's giving us an early signal during that point there when it had a little drop off. Remember, divergence don't always drop in a crash. This one was obviously a bit more sustained, whereas this one was just a very minor retrace before taking further upside. So don't consider a divergence as a major trend reversal. So basically there's a bearish divergence there, and there's also a bearish divergence on this oscillator in this case. Notice here there's a bearish divergence on the CCI. there is no divergence on the oscillator in this one. So this is usually a better indicator for divergence and getting out early in your trades. So let me just zoom out it for a minute now. Looks a bit busy, I know, but I want you to notice a couple of things here. Notice the downtrend of the this is the hourly chart. Notice the downtrend of this price chart, and you'll notice the drawdown of the profitability. We had a pretty major hits to our drawdown here, and I'm using 100,000 as a baseline, only to allow for this going into the below 100,000. So you can see there that's dropped from a profitability of about 12,782 down to, it's lost quite a bit actually. It's down to about 23,000. So from 112 down to 23,000. So how to avoid that? Now this back test runs throughout the whole period. There's no discrimination on the weekly or daily trend. So what I'm advising you to do is, if I zoom out, again this is on the hourly and this is on the weekly, so we'll zoom out to the start of 2021. You can see there's quite a big decline on the share price on the weekly on the New Zealand US during that period. So if I move the cursor there, you can see there is a slight bullish movement to the upside there. So you might have been caught in a few entries in that little peak there, but then it dropped off. Okay, now that's also applying the hourly oscillator as well. So the idea is to avoid going long when this is also going in a short environment, in a short movement. So you'll notice the impact of your drawdown versus in a pretty strong downtrend price action. I'll quickly show you the Euro British Pound. Now I want you to notice the profitability compared to the New Zealand US. Let's give it a second to build. Now you'll notice here the price is moving more sideways and the drawdown was a lot less of an impact to your profitability. Okay, the harshest part of the drawdown is now being realized here. But notice on the weekly, in that period there, if I move the cursor there, you'll notice on the right, you would have stopped taking trades from that point. So you might have been in a trade going back to this point. You would have actually avoided taking those trades as well, those early trades, even though they're albeit quite minimal. You would have taken a few trades there and a few more during that period. But again, that drawdown would have been avoided had you followed the weekly trend. That's the Euro British Pound. Again, the price action moving sideways. And lastly, I'll show you the US Canadian dollar. This had more of a bullish movement on the price action. So I'm just showing you, comparing the New Zealand US, the Euro British Pound and the US Canadian dollar. You can see that's more of a bullish price action. And you can see there is a lot less drawdown impact on your profitability. So again, the weekly was showing more of a bullish movement. Now, of course, we don't have a crystal ball. We can't all predict the price action is going to move in this way. So I'm just telling you how to avoid selling out using a stop loss, if that's your preference. Otherwise, if you want to use stop losses, then by all means use a stop loss. But I avoid stop losses and I approach this method using the method I just showed with those three currencies. So again, every trade is different. Every chart movement is like a fingerprint. They're all unique. No two charts are the same. You will get some that go in a bullish movement, others that go sideways, and others that go in a more bearish movement. So you have to be, I suppose, ready for any of those approaches and try to tackle it in that way, using the higher way of probability to get out of your trades. So that's where we are at the moment. Lastly, I want to show you as well, going back to some investing rules. You've probably seen this slide previously, but now I've shown you here the currencies. I do trade the currencies and commodities, but I'm just advising you, if you're relatively new to trading, first of all, try and use paper trading as a starting point and apply this in a test environment. But nothing beats putting real money on the line, because paper trading often, if you have a few wins, you get a bit cocky and you can go into real money very confident, and in which case there's a real big chance you can lose your positions or your trades. Having said that, if you're relatively new to trading, I strongly suggest you trade blue chip stocks and avoid speculative stocks. And why blue chip stocks? Because they're typically proven to be, I suppose, reliable companies in the stock market, and if they've been around for a while. So again, try to avoid newcomers into the stock market. As well, blue chip stocks pay dividends. So again, if you're trading something that pays a dividend and price moves against you, then at least you're receiving some level of income, even if you're not buying and selling out immediately. So that's a second dividends for me is a secondary income stream. The buy and sell strategy is the primary income stream. Again, unless you're an experienced trader, avoid shorting positions, go long only because of the above dividend factor. So again, if you're going short and the company or the instrument pays dividends, you'll pay that dividend to those that have gone long. And lastly, don't trade on news. Price is usually factored in the share price. So, generally when a market report comes out or a company report comes out, it's usually too late. The insiders have already taken hold of the trades, and the price is usually either skyrocketed or it's taken a plummet. And if you try to get in on after the fact, then you're generally going to be coming in a bit too late. So that's where we are on that strategy. Again, it was the Smoothed Heiken Ashi oscillator strategy. Hope that's been of benefit to you. Let me know in the comments what you think. This is it's just one of the many strategies you can use using the weekly or daily trend if you're trading on the lower time frames that I always mention. Thanks, guys. Subscribe, like, and let me know if you've got any further feedback, and I'll see you in the next video.